Boost your business IQ. Profit margin ratios explained description. Want to understand where your money's going? We break down key profit margin ratios to help you identify opportunities for growth and cost savings. Hashtag profit margins, hashtag financial analysis, hashtag business growth, hashtag entrepreneurship, hashtag finance tips, hashtag accounting basics, hashtag investment strategy, hashtag KPI, hashtag business insights. Let's break down financial statement profit margin ratio. These ratios are essential tools for understanding a company's profitability, how efficiently it's turning revenue into profit. They help investors, analysts, and management assess a company's financial health and compare its performance to competitors and industry benchmarks. What are profit margin ratios? Profit margin ratios are a category of financial ratios that measure a company's ability to generate profit relative to its revenue, assets, or equity. They indicate how well a company controls its costs and manages its operations to produce profits. They are usually expressed as percentages. Key profit margin ratios and their meanings. Here's a breakdown of the most common profit margin ratios, along with explanations, formulas, and what they tell you. 1. Gross profit margin. Formula. *100 where gross profit equals revenue. Cost of goods sold revenue equals total sales. What it measures? The percentage of revenue remaining after deducting the cost of goods sold. It reflects how efficiently a company manages its production costs. Interpretation. Higher gross profit margin indicates a company is effectively controlling its production costs or has strong pricing power. It suggests the company can generate more profit from each dollar of sales before considering operating expenses. Lower gross profit margin indicates higher production costs, lower pricing power, or a combination of both. It means the company is spending a larger portion of its revenue on producing goods or services. Example: if a company has revenue of $1 million and COGS of $600,000, the gross profit is $400,000. The gross profit mirrors $400,000. The gross profit mirrors *100 equals 40%. This means the company keeps 40 cents of every dollar of sales to cover operating expenses and other costs. 2. Operating profit margin. Formula. *100 where operating profit equals earnings before interest and taxes equals gross profit. Operating expenses. Revenue equals total sales. What it measures? The percentage of revenue remaining after deducting both the cost of goods sold and operating expenses. It reflects how efficiently a company manages its core business operations. Interpretation. Higher operating profit margin indicates efficient operations and good cost control across all aspects of the business. It signals that the company is generating a good profit from its core business activities. Lower operating profit margin indicates higher operating expenses, lower pricing power, or inefficiencies in managing operations. The company might be spending too much on marketing, administration, or research and development. Example: if a company has revenue of $1 million, COGS of $600,000, and operating expenses of $250,000, the operating profit is $150,000. The operating profit margin is 100 equals 15%. This means the company keeps 15 cents of every dollar of sales after paying for both production and operating costs. 3. Net profit margin. Formula. Same where net profit equals earnings after taxes equals operating profit. Interest expense, taxes, revenue equals total sales. What it measures? The percentage of revenue remaining after deducting all expenses, including COGS, operating expenses, interest, and taxes. It represents the company's bottom line profitability, the profit it actually keeps for each dollar of sales. Interpretation. Higher net profit margin indicates overall profitability and efficiency in managing all aspects of the business, including cost control, financing, and tax strategies. It suggests the company is very effective at converting sales into profit. Lower net profit margin indicates higher expenses across the board, including interest or taxes, or lower operational efficiency. The company may have issues with debt, tax management, or overall cost control. Example: if a company has revenue of $1 million and net profit of $50,000, the net profit margin is *100 equals 5%. This means the company keeps 5 cents of every dollar of sales after paying for all expenses, including taxes and interest. 4. Earnings before interest, taxes, depreciation, and amortization margin. Formula. asterisk 100, where EBITDA equals earnings before interest, taxes, depreciation, and amortization revenue equals total sales, what it measures. This margin measures a company's profitability before taking into account interest, taxes, depreciation, and amortization. It is often used to assess the operating performance and profitability of companies with significant fixed assets or high levels of debt. It provides a cleaner picture of a company's underlying operating performance by removing the effects of accounting and financing decisions. Interpretation: higher EBITDA margin suggests the company is generating substantial cash flow from its operations and has a strong operating profitability before considering financing and accounting policies. Lower EBITDA margin indicates operational challenges and a weaker underlying profitability. Example: if a company has revenue of $1 million and EBITDA of $200,000, the EBITDA margin is asterisk 100 equals 20%. This means that for every dollar of sales, the company generates 20 cents in EBITDA before interest, taxes, depreciation, and amortization. What to do with profit margin? Ratios analysis and interpretation. Trend analysis. Calculate the ratios for multiple periods to identify trends. Is the margin improving, declining, or staying stable? A declining margin may signal problems. Benchmarking. Compare the company's ratios to those of its competitors and industry averages. This helps assess whether the company is performing better or worse than its peers. Resources for this include industry reports, financial databases, and competitor filings. Identify drivers. If a margin is changing, investigate the underlying factors. Gross profit margin changes. Look at changes in COGS and pricing strategies. Operating profit margin changes. Analyze changes in operating expenses and their relationship to revenue. Net profit margin changes. Examine interest expense, tax rates, and any unusual gains or losses. Consider the industry. Profit margins vary significantly across industries. For example, software companies often have higher profit margins than grocery stores. Look at the bigger picture. Profit margins are just one piece of the financial puzzle. Consider them in conjunction with other financial ratios and qualitative factors to get a comprehensive understanding of the company's performance. Important considerations. Accounting methods. Different accounting methods can affect profit margins. Be sure to understand the company's accounting policies. One-time events, unusual gains or losses can distort profit margins. Adjust for these items when analyzing trends. Revenue recognition. Understand how the company recognizes revenue. Aggressive revenue recognition policies can inflate profit margins in the short term. Seasonality. Some businesses have seasonal sales patterns. Compare profit margins for similar periods. Manipulation. While rare, it's important to be aware that financial statements can be manipulated. Look for red flags, such as unexplained changes in margins or unusual transactions. In summary, profit margin ratios are a vital tool for evaluating a company's profitability and efficiency. By understanding these ratios and analyzing them in context, you can gain valuable insights into a company's financial health and performance. Remember to compare these ratios to industry benchmarks and analyze trends over time for a more comprehensive assessment.